Good morning, everyone. Thank you for joining us for the third Clarion Markets Market Update webinar. For those of you who don't know, my name is Sam Petts, Chairman of the Clarion Investment Committee, and I'm delighted to welcome Toby Ricketts, CEO of Markets, again today to give us an update presentation on where we feel the markets are at the moment. We'll be running through some slides. If you have any questions, please feel free to send them through and we'll cover those at the end. Otherwise, I'll hand over to you now, Toby.
Thank you, Sam, and good morning, everybody. It's a very interesting time to talk about markets because every so often you progress from one cycle into the next, and we feel at the moment we're on the cusp of one of those changes. If I can relate it to football, and many of you realise I'm not really a huge football fan, but when I first went to secondary school, Liverpool were winning everything, so they came first or second in the league. And I remember we started gambling at a young age, and the odds for Liverpool winning were always quite tight. But actually, they went on not to win for a very long time, and it became an era of dominance for Manchester United. But yet it took quite a long time, really, for the bookies to realise that, and the odds on Liverpool remained quite tight for a long time. And from a market point of view, it feels like one of those periods of transition. The last cycle, we think, really started around 2008-9, where you remember global banks, which at the time people thought were very healthy and well regulated, started to fail because they lent too much money essentially to people who weren't able to pay it back. And in response, governments, particularly in the US, the Federal Reserve, their central bank, the equivalent of the Bank of England, started to push money into the system, printed money, which was something that hadn't been tried for quite a long time. The very first program, I don't know how many people will remember this, was called TARP. It was called the Troubled Assets Relief Program. And essentially it was money that was there to shore up the troubled assets all owned by the banks. And this money was really there to shore up their balance sheet so they could continue to provide liquidity to savers. And the figure was, at the time, it caused a huge drawing in of breath, and it was $700 billion. Well, this policy turned out to be very popular. Printing money to resolve problems seemed almost a victimless crime. And so throughout the following several years, the US actually printed nearly $3 trillion in money. And as a result of that, brought interest rates down to extremely low levels, helped, of course, by very low levels of inflation in the background. The taps were really turned on, from a gush to a torrent when we moved into the pandemic, and banks around the world through COVID printed a further, well, we think it was about $8 trillion. So bear in mind, it took nearly a decade to print 3 trillion, and then 8 trillion was printed in a matter of 18 months. Clearly, this policy tested probably the limits, and as a consequence, we've now, or partially as a consequence of that and other factors that I mentioned, we are moving into a period of much higher inflation now than we've seen for a long time. And that era of moving from very low interest rates to much higher interest rates has happened very suddenly. If you think only, what would it be, 18 months ago, interest rates were ultra low, and here we are having seen successive rate rises, more than we've seen in a generation, to the current position. And clearly that has an effect on economies, and it has an effect on investment strategies, and it's a significant change to the way in which we think money should be managed to be effective going forward. So I'll start with that sort of outline. It's not just inflation that I'll talk about, but I will focus on that and then lead into another few factors that we think are important. So just a quick notice, I'm sure everybody knows that nothing in this presentation is intended as advice, but hopefully it's useful information and it's informative. So the first slide, I thought we'd start with a sort of a silent quiz. Year to date, so this is 2023 to date, it seems to have gone very quickly so far this year. Looking at these asset classes on the right-hand side, gilts, Asia Pacific, Europe, I've listed them there, hopefully in no particular order. And I'm just going to reveal one by one from the worst performing to the best performing areas. So if you want to join in, just have a think what you think will come in and where. So far this year, the first and the worst performer has actually been Asia Pacific, which has fallen so far by -2.62%. And this was up to Friday's figures. This is a bit of a surprise and a head scratcher for us, actually, because the Chinese economy was very late to reopen. You might have read in the press that China pursued a zero COVID policy for far longer than the West did. And as a result of that, their lockdown continued all the way through 2022. And only really did the policy change in 2023 when there was the first glimmers really of some social unrest, which I think made the authorities a bit nervous. And of course, the success of the reopening Western economy sort of led, I think, to a change in strategy. Now, China performed and Asia Pacific performed very well actually through COVID. So to some extent, maybe the recent poor performance is partly a consequence of stronger performance previously. But nevertheless, we did expect the opening of the Chinese economy, which led to surging demand, to provide a boost really to Asia Pacific asset prices, which we haven't seen yet. But I'll come back to that a bit later. There's a number of points here that I'll try and link up through the presentation. The second is UK gilts. I mean, it's simply lending money to the British government. Pretty lacklustre return, but nevertheless positive. And then sterling corporate bonds, similar to gilts, really, but these are loans to companies rather than to a government. So they have a bit more credit risk, but essentially they're just a promise to pay a return, a fixed return over a period of time until ultimately a redemption point. But as we move into the equity markets, this one's a bit interesting. North America really dominated investment returns for the last decade. This era of ultra cheap money combined with a risk-taking culture, which the US has, and an entrepreneurial style very much suited US markets. And we really saw some very, very strong returns from the US. I think what's interesting, other than Asia, which I've mentioned, year to date, we've really seen North America start to drop back into the pack. And we think over the next cycle, this will be one of the big changes, whereas US assets have led for so long, and just as Liverpool were expected to win, I think in a lot of cases there's an expectation that American assets will do well. We've seen actually in the year to date a change in that trend, and we think that may well continue for some time. An interesting statistic that's I think worth a little consideration is that of all the assets owned globally that are quoted on the stock market, 60% of the value of global assets are in the US. So the US market by far dominates globally. Yet from a population point of view, the US only accounts for about 6%. And you're seeing a challenge really to this global order that the US is the financial hub of the world from China and Asia more generally. And we think that sort of disproportionate value of US assets on a very long-term basis sort of feels inherently something that is likely to change, certainly over the next generation to come and the generation beyond them. The UK, market which has suffered a lot of negativity, especially over Brexit, arguably some quite poor leadership, uncertainty, and a lack of capital investment. But we are seeing gradually post-Brexit, combined with other reasons, that the UK economy is starting to perform a bit better than expectations, and the market is reflecting that. Japan also a solid performance, 5.63%. But the top performer is Europe at 9%. Now, the 2 points I make here, the first is look at the disparity of returns this year. Europe at 9%, Asia at -2%. Given that companies in these markets generally all access the global economy and to some extent are fueled by the same tides and trends, it's a very different sort of level of returns. But the other thing, and this is probably a bit more surprising, is that Asia, which has performed the least well of these key asset classes, is actually the reason for Europe performing so well, because the reopening of China outside of Asia, Europe is the biggest trading partner with China, and therefore the reopening has had that positive effect on European equities. To some extent, I think that's understandable. But in Asia, we haven't seen that. And I think really from you're looking generally at these sorts of numbers, we would expect better performance from Asia going forward. Just so you can see where those numbers have come from and sort of the volatility of the markets. There you can see really the returns day by day of each of those markets year to date. So I thought I'd focus a little bit on inflation. And when you start to think about inflation, cash really is the first asset class that comes to mind. And so this is 20 years of cash returns on a nominal basis. If you'd invested and had a return equivalent, which of course we never really quite get the Bank of England base rate, but if we had the Bank of England base rate over 20 years, then that's the return profile. And what you see actually is in the early noughties, cash had a reasonable return. And then since the financial crisis, the return has been very low indeed. And cash, there are periods where cash gives a very good return actually. And it's generally when inflation's falling, because as interest rates are high if inflation's high, whereas as inflation falls, the return on cash is actually better than the return on inflation, and therefore you get quite a good return. And there's a real pivotal moment in this, because in 2001, I believe, I'll have to check this, China was permitted to join the World Trade Organization, which sort of gives trading terms with all of the members, which is most of the world. And that really became a moment when China was able to trade far more freely and provide its low-cost labour force, which was the key advantage that China had at the time, to the world. And we know that there's so much manufacturing sort of moved very quickly to China, and it kept prices low. I mean, particularly white goods, as they're called, dishwashers, washing machines, whatever, just for a period in the noughties, just got cheaper and cheaper and cheaper thanks to China, and that had a really strong effect on inflation. If we compare cash and inflation over 20 years, just to give you the other side of that coin, you can see that really from 2003 to more or less the financial crisis, cash gave, not just did it give a return, but if you put £1 away and you can buy a pint of milk with it, in a few years' time, you could still buy the pint of milk and have some change. It gave you a return that actually exceeded the increase in prices generally. But we can see that really change. So from 2008-09, cash has been a really poor investment. It's a good way of swapping value, sell a house and buy something else. But in terms of holding it in its own right, it's been quite poor from 2009 onwards. And particularly recently, we've seen inflation really sort of jump upwards. And I expect a lot of people have read about that in the press. When we look at markets, and year by year, there's always a lot of uncertainty about what a return might be. This pink line is simply the average managed fund. So it gives a good representation really of what the average portfolio will have achieved over this 20 years. And clearly there's years where performance has been much better than cash, years where not so good. But when we think about investments, we sort of zoom out, try to zoom out quite a long time. And over 20 years, we can see market returns have been pretty good. And the final slide, sort of in this part, is just showing I've made inflation measured by the consumer price index a flat line, and we're just showing everything now relative to inflation. So over the last 20 years, the purchasing power of cash with a return equivalent to the Bank of England base rate has dropped by about 20%. So it's been quite a poor return, whereas overall the markets have been a much stronger return, and particularly during the more inflationary periods. And so what I'm leading into really is how we're expecting market returns to change as a result of inflation. So this is data that I took from the Office of National Statistics, and it's just economic growth each year. But the blue line is nominal growth, and the grey line is what's published by the Office of National Statistics, what we read about in the press. And the difference is inflation, because if the economy grows by 1%, it's always a real measure. So if prices rose by 4% and the economy grew by 1%, then clearly money through the till grew by 5%. But when we reduce that by the effect of price rises, then it's only 1%. And so if we look on the left-hand side of this, of these bar charts, we see those periods of very high inflation during the 70s and 80s. And we can see that the economy was growing very, very quickly in terms of money through the till. But when we adjust for inflation, the growth rate was far lower. And there's an old expression that the stockbrokers really coined in the 70s and 80s, because generally economic data in the 70s and 80s, 70s particularly, was quite poor. The stock market returns were actually quite strong. And the phrase that was born out of this was that markets climb walls of worry. And that was sort of the explanation to why markets did so well when actually there was so much striking and wage demands and 3-day weeks and all sort of even energy outages in that period. But it wasn't so much that markets were climbing walls of worry, but when you're valuing a business, it's the money through the till that creates the valuation. If your turnover goes up and your profits go up, then your value goes up. Now, of course, we've got to take the effects of inflation in the background, but companies have shown themselves over time to be very good at passing on costs to their customers, increasing prices when they need to, and maintaining their profits. And that means, importantly, maintaining the value to their investors after the effect of inflation. Now, we sort of forgotten to some extent about how useful this tool is, because as we got to the 90s and the noughties, the difference between the economic growth in nominal terms through the till and the published figures have become very, very similar. And that's because inflation has fallen to very low levels, we say, driven by many things, but particularly globalization and low-cost manufacturing, particularly from China. However, we are just starting now to see a split again in those two measures. And if we think of the UK this year, inflation for 2023 could be as high as 6 or 7%. Economic growth might be positive of 1%, let's say. That means the money through the till is growing by 8%. Economic growth is actually only 1%, a huge difference. And so what we think is that as we move into a period of higher inflation, actually those sort of cash and bond type returns will be less attractive and actually go backwards in real terms. And the benefits of equity markets will once again be seen as they have been seen in previous cycles. So there's a few headlines here. I'll touch on what I think are the really important ones. And I've got a couple of slides to sort of explain it. So we call this a great normalization event because we're going back to what was normal really for a very long period, sort of slightly higher inflation, higher interest rates, having gone through what's been a very abnormal period over the last 10 years. And the adjustment process from one cycle to another will lead to volatility. So all strategies will have periods of performance, all strategies will probably have periods of underperformance in that adjustment. But over the adjustment, the strategies that have anticipated the changes will actually be those that outperform. There's a lot of clutter in markets. I think you sort of can feel that just from the press. And the reason for the clutter is we're not worried about banks and governments making a policy error. They've already made the policy error. The amount of money printed over COVID was, with hindsight, far too much, and it wasn't done carefully. So the money that was printed through the banking crisis was injected directly into bond markets. But as we know, over COVID, there was helicopter money. People paid under schemes, whether they were working under the furlough scheme, loans into businesses, so no checks and balances. It was almost a giveaway of cash, and that was a policy error that's led to very high levels of inflation. And now the question is, can central banks deal with that without making another policy error? The tightrope is so narrow, it's almost impossible and I think we can expect quite high swings. And actually, even if policy is right, they won't know that it's right for so long afterwards that there will be a question about whether policy area is persisting or not, whether it is or it isn't. We've seen, I thought I'd touch on a few banking concerns. So the Silicon Valley Bank, Credit Suisse, there was another one the other weekend in the States. I should have written down and you wouldn't remember it. It'll come to me. The First Republic, wasn't it? That's right. So as interest rates go up, it puts pressure on business models that were built for low interest rates. And all of those banks had baked into their predictions that interest rates would remain low, and they didn't, and therefore they lost money. And there will be more failures of businesses that were relying on very low interest rates to continue, but they're not linked. So each of these failures, albeit there might be a number of them, will be isolated. And so they will not create the systemic risk that we saw in 2008-9 with the failure of many global banks. But the market might worry at times that that is what's happening. So that's going to create volatility, because where the failures occur, there will be an element of the market that is frightened. But the one thing regulation did very successfully following the bank crisis is it moved the dominoes apart so that when one bank falls, it doesn't knock over another bank. Pre the financial crisis, banks all lent each other money to the extent that the failure of one automatically created the failure of another, and action was required externally, as we discussed. Those dominoes now, there's investors in those banks, as we saw with Credit Suisse, as we saw with Silicon Valley, they lose their money, but it doesn't have this, what we would describe as a systemic effect, where one knocks the other down. I think it'll come the US to be a bit expensive. We think at times the markets will think inflation's going back to low levels and will expect ultra low interest rates again. We think investing on that premise will be dangerous and will result in money being lost. I'll cover that. I'll try and explain that in the slides time. But overall, it's a better environment actually for us to make sensible investment decisions. We know that company earnings do quite well actually when inflation is more elevated. And we are seeing this positivity from the Chinese reopening, which we think has got some further growth through this year and into next. And it's really the China reopening coupled with savings from COVID that so far we think will just about avert any significant recession, although we might see a mild, potentially mild, and it could be a long mild recession. But we don't think that would be detrimental overall to investor returns. So I'll try and explain inflation. And this really, I suppose, highlights the difficulty in thinking about both the short term and the long term. So the first thing I'll say about inflation is we're going to go from the amber line of 2% long run inflation that we've seen for the last cycle, we think, to a higher level of inflation, maybe 3 to 4% long term. And the key reasons that inflation is going to be higher is because the West has reduced trust in Russia clearly and in China, and therefore global trade is going to be more difficult, and countries are going to rely more on supply chains that they can trust rather than that are absolutely the cheapest supply chain they can get hold of. And the impact of Russia's invasion of Ukraine is likely to take a generation or more to resolve, and that's if it can be resolved. I mean, that's clearly for as long as we can see at the moment, there's going to be very difficult relationships between the West and Russia, and also to some extent China. So inflation moves up higher, and we've got that expectation. In the short term, though, inflation is coming screaming down because it pinged so aggressively following the reopening of COVID that we saw these very high figures, and now from those figures we're going to see a big reduction, and essentially and then the secondary effects as wage inflation starts to have that secondary effect. We're seeing wage demands being largely met and a lot of pressure on private sector wages. So there is scope, so I flipped on there is scope for the market to see inflation coming down and almost breathe a sigh of relief that we're going back to the good old recent days, whereas in fact it's going to be a temporary relief as we see this skipping rope develop, and it takes some time for this higher inflation environment to be clear. And really, if we look at that on interest rates, or using government bonds here as a proxy for interest rates, because the data goes back so far, but we can see that the long-term average has been about 4%, but naturally we've seen swings both sides of that. Very, very high swing in the 70s and 80s, and then this corresponding drop to almost zero. And now we're after the red circle. This is just my freehand drawing, but we can see that rates have risen up, and we expect though that we're going to see borrowing rates sort of for the next cycle average around the 4% mark. I mean, short term, could it be 5 or 6? Well, it could be, or it might be a bit less. But the main point here is we don't see a drop back to these sort of 1% interest rates that we saw in COVID. And it's worth remembering that just 18 months ago, the UK government could borrow for 25 years at less than 1%. So we've seen markets move a long way since then. In terms of why inflation is going to fall, there's a high level of predictability to inflation. So I try and direct you here to the 12-month CPI rate, which is next to these circled numbers. So in March last year, it was 7%, and it went to 9.1, peaked in October at 11.1, and here we are in March at 10.1. But each 12-month number is made up of 12 one-month numbers, and this is what I've circled. And so every month we go forward, we lose a month and we gain a month. So in March, we lost 1.1 and we gained 0.8. So the annual figure went from 10.4 to 10.1. So hopefully you're following me. The point is that over the next few months, look at the numbers that drop out of 1.1, 2.5, 0.7, 0.8, and so on, even in October at 2. And it's very likely that the numbers that come in going forward are going to be the same magnitude. And therefore, if I can just flip back, this downward curve of inflation is fairly likely when we look at the composition of the numbers. And in April, when we lose a 2.5 and probably gain a very small digit, that's going to suddenly take inflation from 10 to 7.5, and there might be a feeling that it's rushing back down. And the reason the new numbers are going to be quite low is because the Ukraine invasion invoked inflation has now all reversed. So apologies if you can't see the titles, but the top left is oil, the bottom left is natural gas, and wheat is on the right. And you can see all of these key components, exports from Russia and from Ukraine, are all now below, quite substantially below in some cases, the pre-invasion level. So the new numbers are going to be quite low, and the numbers dropping are quite high, and so we can see inflation is at least going to come down quite rapidly. Looking at the yield curve, this simply shows what interest rates are expected to be going forward, and at the moment, rates are sort of this is for the US, but what happens in the US has an effect on all of Western markets. US rates are about 5.25 at the moment, and then over time they come down. If you lend for 2 years or 5 years, you actually get less of a return. And what we're expecting to see is that as inflation starts to come down, central banks will moderate towards in the middle of next year, maybe we might see some short-term drop in interest rates. But importantly, as it becomes clear that inflation is going to be stronger for longer, actually we'll see a lifting in longer-term rates. And this yield curve, we think, will turn into this sort of upward slope, at which point we as investment managers will start to see an advantage really in buying government bonds. Just to let you know, while that curve changes shape, actually, there's still the prospect for losses in those markets. So we're sort of carefully avoiding that risk at the moment. So just a final slide before I come to the outlook and try and gather everything together. This shows this really explains why the US has been so strong in its performance. And so the blue line here, it shows that tech and the US market has got a lot more technology type stocks than the rest of the world. And technology stocks generally have a higher value than other types of investment. And the premium is about 1.2. And we can see that actually over from 2015 onwards, we've seen technology stocks become much more valuable than the rest of the world, driven, we think, really by access to low cost borrowing. And although we saw a bit of bad performance last year from the US, the valuations have still remained quite toppy. And within this market, you're thinking of a recession, it's likely actually that we'll see those valuations normalise and maybe go a bit below normal. And really this graph makes the point in figures that I was trying to make at the start, which is that the US, having had a very good period of outperformance, probably looks set for more normal performance. And consequently, certainly compared to our peer group, we've got less weightings in the US and more elsewhere. So if I try and bring it all together, actually outside of the US, valuations are really attractive. You know, the UK, Europe, Asia, all really well down on their highs, and very much attractive when we look at their long-term average valuations. We've seen high growth, high multiple, high capital consumption stocks. What are they? Tesla's the one that always comes to mind. These are businesses that are very fashionable and trendy. They're very expensive. They may change the world and make a fortune. Equally, maybe that doesn't happen and investors lose a lot of money. And there's been a lot of these sort of trendy stocks around in the past. You remember things like America Online is always one that people remember, lastminute.com and so on. And some of these stocks do make it, out of the tech bubble in the 2000s. The one that did make it was Amazon, where obviously 100 tech stocks that failed, that crashed 90%. Amazon was, I think, the only one actually that did actually recover and make a profit. But actually, in those sorts of markets, when capital becomes more expensive, generally those stocks underperform. So we're aware of that. The future growth stocks will probably be companies that we haven't really heard much about at the moment, and we'll find those to using managers who really pick through and carefully look at those smaller stocks as the ones that have got ideas that will deliver in the long term. We expect inflation to average that sort of 3 to 4% figure, and therefore real assets. UK is already doing well. Asia we expect to recover. Europe and Japan, really anything outside of the US does look attractive at the moment. We know there's been a bit of fear about a banking crisis, but markets tend to look forward to the next crisis based on the last crisis, whereas actually the next crisis will probably come from something completely different, or nearly always does. So we're not concerned about a banking crisis at the moment. A crisis we're more concerned about actually is, you might have heard of private equity markets. They're very big in the US. They buy businesses with a bit of client money and a lot of borrowed money. And as the cost, and it's a multi-trillion market built very rapidly over the last 10 years, as the cost of borrowing increases, that business model starts to look under some stress. And that, if we were concerned about a crisis, that's where the sort of area we would see it. And again, that would be another reason to just be a bit more worried about US markets. And in terms of a recession, well, we probably, even since I wrote this slide, it's looking a bit better, but we think banks will tighten until they get a recession. That will sort of be their measure as to when they've done as much as they can. And it might be a mild recession, it will be a mild recession, but it might not feel like one, because if I just go back to one of the slides I used earlier, if inflation is at 3 or 4%, even if a recession is, we're losing 0.5% or 1% of economic growth a year, the money through the tills in the economy is going to be growing by 2 or 3% in any case. So it might not feel like a recession to a lot of people, and certainly not to investors. So, Sam, if I can pass back to you for any questions on that note.
Yeah, that's great. Yeah, thanks very much, Toby. Anyway, so we just have a couple of questions which have just come through. One does focus on US banks, and in particular some of these regional banks where there's been a few issues, particularly on the press. And do you feel that is contained to that particular area, given the sort of nature of what they've been doing with their balance sheets?
Yeah, so we do, and we've been thinking about this quite carefully, talking to our colleagues in the investment banks that have US businesses. So it's a bit of a different model. In Europe, all the banks are regulated to a very high standard. In the US, the big banks have similar regulation, but then there's a lot of local banks called mama and papa banks that essentially operate under much more relaxed regulation. And they could, and they will have got themselves into trouble. Now, what's clear is that the Fed are going to guarantee savers deposits, which limits the economic damage. But we will see some of these banks, if they lose the confidence of their savers and there's big withdrawals, they then become sitting ducks for other banks to take them over. And where they have, they're making good profits. So in terms of would you want to be an investor in these banks? Probably not, unless you feel able to spot which are the winners and which are the losers. But in terms of outside of the banks themselves as investors, we see very limited risk really to any economic spillover from their failures. But there almost certainly will be more. There will be more failures, but not anything that we think drips into having an economic impact.
Yeah. Okay. All right. Great stuff. And there's just another one also just come through. I think you touched on the sort of demographic differences between US and in particular Asia at the very start, basically. So would you be able just to sort of flesh that out as to why the demographic sort of nature behind the Asia region makes it a slightly more attractive long-term investment case? Just focus a little bit more on that, please.
There's quite a lot to this question. And what we're seeing at the moment with Russia's invasion of Ukraine and China's, wouldn't call it support for Russia, but certainly their unlimited partnership and not condemning Russia, there's clearly a challenge coming from China now regarding what is described as a polar world. At the moment, the US essentially create the rules and the standards that they hold, or that the world is held to account. And China is looking really for a bipolar world. It thinks that the renminbi should rival the dollar, and particularly that the abundance of US assets in the global economy compared to the size of their population is misaligned. And what you see in Asia is a much higher population, a much younger population, and actually a population generally more willing to work to achieve higher living standards. And therefore, those factors are likely to drive to much better and longer economic growth. And therefore, we think if you were investing for 100 years, you would overweight Asia, clearly, because the Asian economy is only account for about 9% of global assets. But those changes are going to, although they're profound, they're going to happen over such a long period of time. It's not really a trend, I think, that you can rely on in the next 5 years. But it is one just to bear in mind as a sort of a general tailwind, I think, for Asia and a headwind for the US. And the role of the US in policing and setting standards for the global economy is a question really that is being asked. And part of the wrinkles we're seeing in geopolitical relationships is that challenge. So I appreciate I haven't really given I don't think there's really a full answer to that question, except it's an awareness to build into investment strategies. So that clearly is the case. China now with its economy that rivals the US in terms of output, although not per GDP, not per capita, it is definitely able to exert pressure against the US, and the US is nervous of China, as we're seeing with the discussions over Taiwan.
Yeah, very good. That's great. Well, if there's any other further questions, then feel free to contact your Clarion sort of representative or advisor. Otherwise, it just leaves me to say thank you for joining us today, and thank you for Toby for the presentation. The next webinar will be towards the end of this year, probably around November time, and we look forward to seeing you all again then. Okay, thanks very much.
Thanks all. Bye bye.